India's IPO market has gone absolutely crazy. We're talking about a world where newly public startups are worth more than 100-year-old stock exchanges, where companies that were making losses yesterday are suddenly printing money today, right before they go public, and where retail investors are throwing billions at companies trading at 100x earnings, just because the gray market premium looks good. Welcome to the land of crazy IPOs. Is this brilliance, or are we watching the biggest retail investor trap in history? Let's find out. Let's start with the most insane stat of 2025. A fintech startup that's only 8 years old is now worth more than the Bombay Stock Exchange, an institution that's been around for 150 years. I'm talking about Groww. Groww's IPO opened at 95 to 100 rupees per share in November 2025. Within days, their stock surged 94%, taking its market cap to over 1.1 lakh crore, that is $13 billion. To put that in perspective, Groww is now worth more than the Bombay Stock Exchange, the very platform it trades on. The IPO was oversubscribed multiple times. Retail investors could not get enough. But here's where it gets interesting. Groww is trading at 34 to 44 times its FY25 earnings, nearly double what its competitors like Angel One, that is trading at 20x, and Anand Rathi, that is trading at 25x. The fundamentals: revenue grew from 1,141 crores in FY23 to 3,902 crore in FY25. Profit jumped from 458 crore to 1,824 crore. Impressive growth, no doubt. But here's the question: does that justify being worth more than a 150-year-old institution? The market says yes. Logic says maybe not. Next up, Lenskart, valued at $8.4 billion at its IPO. The IPO was fully subscribed with a grey market premium of worth 75 rupees, a signal that retail investors were betting big. Here's the thing: Lenskart was losing money for years. FY22 loss of 102 crores, FY23 loss of 64 crore, FY24 loss of 10 crore, but then miraculously, FY25 marked the first year of profitability, 297 crore in profit. Convenient timing, right? Just in time for the IPO roadshow. Suddenly, the story changes from we are burning cash to grow to we are profitable, sustainable business. And the market rewarded them with a sky high valuation. Then there's Pine Labs, the digital payments giant. IPO price 210 to 221 rupees per share. Total raise 3,900 crores. Subscription was solid. Institutional investors subscribed 4x, overall around 2.5x. The stock listed at a 9.5% premium, opening at 242 versus the issue price of 221. The catch: the company's profitability details are murky. It's all about growth and market share, but investors didn't care. The name recognition and the promise of India's digital payment boom was enough. And here's the wildest one: PhysicsWallah, the edtech unicorn. The company raised 3,480 crore through its IPO, priced at 109 rupees per share. Initial response muted. The IPO was only subscribed 1.81 times, one of the weakest responses of the year. Retail investors barely showed up, with only 48% of the retail portion getting bids. But then something interesting happened. Institutional investors, the QIBs, stepped in and subscribed 2.7x. The grey market premium was only 14 rupees, suggesting a modest 12 to 13% listing gain. What actually happened on the listing day? The stock opened at 145 rupees on National Stock Exchange, a massive 33% premium over the IPO price. It even touched 162 rupees during the day, hitting nearly 50% gains. This made PhysicsWallah the second best new age IPO listing of 2025, behind only Urban Company's 57.5% gain. Now here's the kicker: PhysicsWallah is still losing money. FY23 loss of 84 crore, FY24 loss of 1,131 crore, FY25 loss of 243 crore, and in Q1 FY26 still unprofitable. Yet the market gave it a 40,000 crore valuation on the listing day. Why? Because in India's IPO market, losses don't matter anymore, or at least they don't seem to. What matters is story, and PhysicsWallah has a great one: affordable education, hybrid offline online model, and a charismatic founder. So here's the question no one is asking: why do all these companies except PhysicsWallah suddenly become profitable right before their IPO? Is it a coincidence or is it strategic? Let's look at the pattern. Lenskart, years of losses, then boom, 297 crore profit in FY25, right before the IPO. Groww reported an 805 crore loss in FY25 due to one-time tax haven for shifting domicile from the US to India. But in FY25, suddenly 1,824 crore profit. Nykaa lost 16 crore in FY20, then reported a 61.9 crore profit in FY21, the year it went public. Zomato was losing over 2,000 crores a year for years. Then, just before the 2021 IPO, losses narrowed significantly. Notice the pattern? Companies magically turn profitable right when they need to impress public market investors. How do they do this? Here's how it works. Number one, cut marketing spend aggressively. Paytm, for example, slashed marketing by 62% before its IPO. Number two, delay expansion plans. Stop opening new stores, freeze hiring, postpone product launches. Number three, accounting adjustments. One-time write-downs, reclassifying expenses, recognizing revenue early. Number four, unit economics sleight of hand. Zomato improved its contribution margin per order right before its IPO, even though the total revenue actually fell by 23%. The goal is to create a profitable quarter or year that can be plastered on the IPO prospectus. Once the IPO is done and the money is raised, the spending resumes. But PhysicsWallah proved you don't even need to do that anymore. You can be openly unprofitable, losing 243 crores per year, and still get a successful IPO with a 33% listing gain. That tells you everything you need to know about the Indian startup IPO market right now. Fundamentals are optional, the story is everything. Now, this isn't the first time India has gone IPO crazy. Let's look at the class of 2021. Zomato went public in July 2021 at 76 rupees per share. The IPO was massively oversubscribed. The stock soared on day one. But here's the reality. Zomato had been losing billions for years. At IPO, it was still unprofitable. The stock crashed after the hype faded, falling over 60% at one point. Today, it's recovered and trades at a crazy high PE multiple, but only because it finally turned consistently profitable in 2024. Then there's Paytm, India's largest ever IPO at the time, raised 18,300 crores. The company was still losing 1,710 crore a year at IPO, despite cutting its losses by 42%. The stock listed, then immediately tanked. It fell over 75% from its IPO price. Retail investor lost billions. Why? Because the fundamentals didn't support the valuation. It was all hype. Nykaa is a rare success story. It went public in 2021, actually was profitable, 61.9 crore in FY21, and the stock has held up. But even Nykaa trades at insane multiples, price to sales of over 200x at one point. That's not rational, that's euphoria. And then there's Ola Electric. The EV startup went public in 2024 despite losing 1,584 crore in FY24. The IPO was oversubscribed, the stock surged, and then reality hit. The stock has since crashed as production issues, customer complaints, and continued losses mounted. Yet, at IPO, retail investors came flocking based on the hype alone. So, why do Indian retail investors keep falling for this? Three reasons. Reason one, grey market premium FOMO. The grey market premium is the unofficial premium at which IPO shares trade before they are officially listed. If the GMP is 50 rupees to 75 rupees, retail investors think I'll make instant money on day one, so they subscribe without looking at the fundamentals. PhysicsWallah's GMP was only 14 rupees, but it listed at a 33% premium, beating even the grey market expectations. That kind of surprise win creates FOMO for the next IPO. Reason two, the next big thing narrative. Investors believe that these companies are the next Amazon or the next Google. The Indian growth story is real 500 million internet users, rising incomes, and digital adoption. But that doesn't mean every startup deserves a 50x valuation. Yet the market prices them like they're all going to be trillion-dollar companies. Reason three, liquidity and scarcity. India's stock market is flooded with liquidity. Millions of new retail investors joined during COVID. There's more money than quality IPOs. So when a hot IPO comes along, there's a stampede. It's not about the business, it's about getting a piece of the action. Now here's where the story gets even more interesting. Let's compare India's IPO mania to the US market and why companies are literally packing up and moving from the US to India just to go public. In the US, investors got burned by 2021 SPAC bubble. Companies like WeWork, Robinhood, and Peloton crashed. Now, US investors are skeptical. They demand profitability, reasonable valuations, and a clear path to growth. Instacart's IPO flat. Birkenstock flopped. Even ARM, the chip designer, had a muted debut. And here's the kicker. To list on US exchanges, you typically need $400 to $500 million in annual revenue. That's a massive bar that most Indian startups simply can't clear. While in India, a software company with just $50 to $60 million in revenue can list successfully. In Q1 2025 alone, India had 62 IPOs raising $2.8 billion, accounting for 22% of global IPO action. The math is simple: easier listing requirements, higher valuations, and retail investors with unlimited appetite for growth stories. And this brings us to the most fascinating trend: reverse flipping. Over 40 Indian startups are currently in the process of moving their legal headquarters from the US, Singapore, and other countries back to India, specifically to take advantage of the favorable IPO market. Let me give you some examples. Groww, originally incorporated in Delaware, USA, moved its parent entity back to India in March 2024, just months before its blockbuster IPO. The company paid 1,340 crores in taxes to make the shift. PhonePe shifted from Singapore to India in 2022, paid a staggering 8,000 crore in taxes to complete the move. Zepto completed the reverse merger from Singapore to India in January 2025, calling it a historic milestone and a sign of long-term confidence in the Indian capital markets. Meesho shifted domicile from the US to India in 2025 ahead of its planned IPO. Razorpay currently shifting from the US to India and paying over $100 million in taxes to do it. Flipkart board approved moving from Singapore to India ahead of its 2026 IPO. These aren't small companies, these are unicorns, billion-dollar startups that were originally founded and headquartered in the US or Singapore, specifically to access global capital. But now they are coming home. Why? Because India's IPO market is more lucrative. But why are they doing this? Three reasons. Number one, access to capital. Indian retail and institutional investors are throwing money at tech IPOs. The demand is insatiable. Number two, lower listing requirements. You don't need $500 million in revenue like you do in the US. $50 to $60 million is enough. Number three, higher valuations. Indian markets are giving these companies 2x to 3x the multiples they'd get in the US. The Indian government has made it easier too. In 2024, they removed the requirement for National Company Law Tribunal approval for mergers, cutting the process from over a year to just 3 to 6 months. They've also created Gift City, India's answer to Singapore and Delaware, offering tax incentives and simplified compliance. So let me get this straight. Indian startups that spent years raising money in the US, structured themselves under Delaware law, and built their entire cap table around foreign investors are now paying hundreds of millions in taxes to move back to India just so they can IPO here instead of the US. That tells you everything about the difference between the two markets. The US wants proof, India just wants a story. And right now, the story is worth more. So, is India's IPO market visionary or just plain crazy? Here's the truth: some of these companies will become giants. Groww might be the Robinhood of India. Zomato might dominate food delivery for decades. PhysicsWallah might revolutionize education. But many won't. And when you're paying 50x, 100x earnings, or buying companies that are openly losing money, you're not investing, you're gambling. The sudden profitability before IPOs? That's not a coincidence, it's a strategy. Companies moving their entire legal headquarters from the US to India just to list here, that's not patriotism, it's arbitrage. And retail investors are the ones left holding the bag when the music stops. My advice: look at the fundamentals, ignore the GMP, and remember, in the long run, valuations always revert to reality. If you enjoyed this deep dive, hit that subscribe button. Drop a comment. What's the craziest IPO you have seen? Do you think India's market is the future or a bubble waiting to pop? We'll see you next week with more from the front lines of global investing. VC10X.